kicking off. Ed,
Cool,
all
great.
yours.
Brilliant, thank you. Can everyone, is my screen clear? Yeah, can everyone see the presentation?
Perfect.
All right, great. Okay, well, look, thanks all for thanks for giving me the opportunity to present today, and thanks for attending. So look, let me just start by introducing myself. So I'm Ed Ball. I'm a vice president in the restructuring team here at Lazard in London. And I'll just give you a sort of whistle-stop tour of my CV to sort of just give a bit of context to myself, to the extent that it's of interest. So I got my GCSEs and A-levels from a place called Bideford College, so a rural kind of state-funded secondary school in the county of Devon, which has actually only just been rated good by Ofsted for its first time. Okay, so I think this SEO scheme is a fantastic scheme. I got a lot of sympathy for it, and to be honest with you, I think I would have got a lot of benefit from myself. I sort of graduated, so I left Bideford College in 2006. Went to the University of Manchester to study philosophy and politics. Why did I do philosophy and politics? It's something that interested me. I didn't really know what I wanted to do in terms of a career, and I think we're lucky in the UK in that there's lots of graduate schemes that don't sort of discriminate between different types of degree. They just kind of welcome anyone who has a degree. I graduated from Manchester Uni in 2010, moved down to London with some friends, and without a plan, ended up working in a pop-up bar in Peckham, whilst I kind of worked out what I wanted to do. I ended up getting a job basically as a stopgap at a small firm of chartered accountants and insolvency practitioners called David Rubin and Partners, which is in East Finchley. And I kind of worked there for about 18 months whilst I thought about what graduate schemes I wanted to do and what I wanted to do in terms of a career. I thought about working for one of the big four, but the one thing that put me off is that all I really understood them to do was audit, which didn't really sort of excite or interest me that much. But what I realized from working at this job in David Rubin and Partners, and what you got to bear in mind is that 2010 was the kind of economic nadir, right? We were sort of just 18 months after the peak of the financial crisis. Is that sort of job actually introduced me to the whole world of insolvency, distress, restructuring, recovery, etc., etc. And it made me realize that each of the big four had a discrete graduate scheme in that field. So I applied to, in sort of 2011, I applied to all of the big four to work in their respective, restructuring departments. And I got a job at PwC, where I ended up working for about 5.5 years. I did their usual sort of, kind of ACA scheme. So I got the ACA, in 2015. And when I was at PwC, I worked in the full kind of spectrum of business recovery services, which we'll come on to in a moment, but that ranges like from financial, balance sheet restructuring to operational restructuring, cost cutting, etc. Involves companies both like, large cap and small cap, insolvency appointments like administrations, liquidations, etc. They even work with sort of pension trustees as well. In 2018, I received a call from a recruitment agent that was looking for an associate for Lazard. Having worked at PwC for about 5.5 years, I was ready to move at that point in time, and was quite excited by the prospect of moving from an accountancy orientated practice to an investment bank. And interviewed with the team at Lazard, which I'll come on to in a moment, and the rest is history effectively. I joined Lazard in 2018, was promoted from associate to VP in 2020, and I've worked on numerous transactions ever since. I've had really good deal flow at Lazard, much better than I did at PwC. We in the restructuring team are sector agnostic, so we work in companies in all different sectors, but I've ended up for purely sort of coincidental reasons gravitating towards oil and gas companies and government outsourcing companies. So some of the companies that I've worked on that you might be familiar with are companies like Interserve and Kia, and then a bunch of oil and gas companies as well. So that's the kind of whistle-stop tour of me and my CV, if it's of interest to you. In terms of the Lazard restructuring team, we have a team of 17 bankers, ranging from analysts to MDs, and I'm squarely in the middle there, at the kind of VP level. And then let's just move next out into actually some of the content. So what is restructuring? So look, I think the first thing to say is restructuring is effectively the application of corporate finance techniques, including M&A, to companies that are facing capital structure challenges. So what we're trying to do here is we're trying to fix companies with broken balance sheets. Okay, companies that basically have too much debt, unsustainable amount of debt, companies that are running out of cash, have liquidity issues, etc. And we are, like I say, focused on dealing with the balance sheet. Okay, we are not operational consultants. So we're not McKinsey, we're not BCG. We don't go into a company and say, hey, look, in order to turn around your operations, you can cut costs here, you can, expand production footprint here, etc., etc. That's a different sort of line of work. The restructuring business is very much core to Lazard, and the reason for that is that it's counter-cyclical, right? So if you're in an economic downturn, as everyone expects we will be potentially in the fairly near term, activity in mergers and acquisitions, in debt capital markets and equity capital markets, that all deteriorates, right? That comes down inevitably because there's less market optimism, there's less cash flowing through the system, etc. But conversely, restructuring activity goes up because companies start to struggle and they need our help. And so we are really a very core part of the business, as is the restructuring team in other investment banks, in order to smooth out revenues over the long term. In terms of Lazard, look, I mean, every investment bank will tell you this, but we we genuinely are we do have a world leading restructuring franchise. We're very, very strong in the US, where we do a lot of Chapter 11 bankruptcies. We're strong in the UK, in France, and we also have kind of capability on the ground in Spain and Italy, and elsewhere. And we often top the tables, in terms of ranking. In terms of who our key competitors are, it's the other independent investment banks, which you can see on the right hand side, right? So we compete against the likes of PJT, Rothschild, Houlihan Lokey, and Moelis. The types of investment banks we don't tend to compete against are the balance sheet banks, so Morgan Stanley, Goldman Sachs, JP Morgan, etc. Some of those do have their own restructuring team, but they often find themselves unable to kind of pitch for mandates because they can come into conflict as a consequence of potentially being in the debt itself, or wanting to sell debt to the company, etc., etc. We, on the other hand, are very independent, unbiased, because we don't have a balance sheet, right? We just provide financial advice. We're not providing products. The other types of institution that we compete against are the accountancy firms, although frankly this is becoming less and less frequent. So like I say, I mean, I come from PwC, EY also do this work, and you may be familiar with companies like Teneo and Interpath, which used to be which are basically Deloitte and KPMG's former restructuring arms. And there's also companies out there like FTI, Alex Partners, Alvarez and Marsal, etc., that do more in terms of cash management, operational restructuring, but also are quasi competitors as well. So look, next question, how do companies end up in restructuring? There's a number of issues, right? But they're probably best bucketed into three. So the first is cyclical issues. Okay, so there are certain sectors and industries that go through periods of expansion and contraction, depending on the sort of macroeconomic outlook. And a very easy and obvious example of that is oil, right? Oil and gas. The kind of the rises and falls of oil and gas companies is clearly strongly linked to the price of the commodity itself. So back in if we look back some distance between 2010 and 2014, those were the boom years for the oil and gas industry, with oil prices in excess of $100 a barrel. In 2014, there was a crash in the oil price, which resulted in a lot of restructurings and consolidations in the industry. Things were improving towards the end of the kind of like 2018, 2019, etc. But then COVID happened, which resulted in again another crash in the oil price. And now we're on the other side of COVID, more or less, and supply chains are tight. Economic activity has ramped up, and things have been exacerbated by the war between Russia and Ukraine. That has sent oil and gas prices through the roof again. And so that's a classic case of companies that need restructuring because of cyclical issues. And if you see you see one of the logos there, Premier Oil, I've actually restructured that company twice, once at PwC in 2015-16, and again at Lazard in 2020. Now that company has been merged with another company called Chrysaor to create the largest oil and gas company in the UK. Harbour Energy, and it is doing phenomenally well because of high oil and gas prices. It is effectively just printing money and has been subject to the windfall tax that you might be familiar with. The other issue is structural issues. Okay, so industries, sectors that are undergoing fundamental change for technological, regulatory, or other reasons. So a classic example of this is retail. Retail companies have obviously been hard hit by changing consumer habits arising as a consequence of the internet, in particular platforms like Amazon, for instance. So we've restructured all sorts of companies in this space, like Debenhams is one example. We were involved with Arcadia in 2020. So yeah, a very good example there of structural issues arising from technological change. Another one is like regulatory reasons. So for instance, the energy sector, certain parts of the energy sector have been impacted, especially in Spain, by changes in the subsidies for renewables companies. And another one is government changes as well. So I've worked on on the restructurings of a lot of government outsourcers, so companies like Interserve, Amy PLC. Some of my colleagues worked on the restructuring of Carillion, which ultimately went bust. And the reasons those companies ended up in restructuring is a change in sort of government spending priorities, right? So before the financial crisis, there was a lot of money being spent on those being directed towards those types of companies. But in the aftermath of the financial crisis, governments just couldn't afford to pay as much as they used to do for those types of contracts. And then there's a whole range of other issues, okay, that can lead to a restructuring. One of them is, a lot of companies are acquired through what's called a leverage buyout, whereby a private equity sponsor, buys a company and funds most of the acquisition price by raising debt against the company itself. And the whole kind of investment rationale is that, they will grow the business such that debt becomes sustainable. But if they don't succeed in that regard, that debt remains unsustainable, becomes more unsustainable. And so that's often a reason for companies ending up in restructuring. Another one is just, mismanagement. Okay, so some companies, they appoint a kind of an executive management team that, are sort of overly bullish, overly ambitious, have a penchant for sort of empire building, and they go on an M&A spree, buy up companies and fail to integrate them, or they overpay for companies, they take on debt to buy those companies, etc., etc. And another common one actually is fraud, which we see more often than we should do, frankly. And then lastly, in terms of other reasons why companies end up in restructuring, shocks, right? Unanticipated shocks. A common one is FX. So we've restructured a lot of companies in Turkey, including Turk Telecom, because of the collapse in the lira. But there's bigger shocks, right? Like COVID-19, for instance. We were enormously busy in 2020 as a consequence of COVID-19, and more recently, the war between Russia and Ukraine. I mean, that hasn't generated as many obvious restructuring opportunities as you might think, but the secondary and tertiary effects in terms of rising energy prices, rising food prices, all of that leading into higher inflation, lower consumer confidence, lower consumer discretionary spending. All of that is going to have a big impact ultimately on the economy at large. And then it's just also worth mentioning that another thing that Lazard does, but not me, this is my colleagues in Paris, we also restructure sovereigns as well. So we have a leading sovereign restructuring practice. We've advised the governments of Argentina, Lebanon, Greece, Ukraine, Zambia on restructuring their sort of balance sheets and negotiating with international creditors and the IMF. So turning to the next slide, I think what's interesting about restructuring is that we're dealing with the entire balance sheet, right? So our scope can be quite a broad one and often incorporates lots of different elements of restructuring. I mean, look, I guess the best way to understand it is that there's often three key triggers for a restructuring happening. And by restructuring, I mean sort of negotiations between the company and its various financial stakeholders, which ultimately leads to a transaction. The most common, I would say, at least in the current context, is refinancing risk. So a company has a big pile of debt, it's maturing in less than 12 months time, and the company is unable to refinance that debt, i.e. is unable to get new debt to replace it because it's over leveraged, or the capital markets just aren't aren't sort of favorable for refinancing. That's one trigger. Another trigger is liquidity. So companies just running out of cash, often for operational reasons or because they have sort of contingent liabilities that they have to pay, etc. And then a third one is what's called covenants. So when you take out debt, you often undertake to maintain certain metrics. So for instance, a certain level of earnings compared to your debt, etc. And if you don't maintain those metrics, the lenders to you are entitled to basically call on all of the debt. So that can be another trigger. And when we find ourselves in a situation like that, we look at each element of the balance sheet and how we can solve that. So starting with the asset side of things, if we're advising a company, for instance, we ask ourselves, look, if we're running out of cash or we have too much debt on the balance sheet, are there some non-core assets that we can dispose of for a decent price to raise cash for liquidity and or to reduce the indebtedness of the business? Or is there a possibility here of selling the entire company or merging the company with another one which is less indebted, such that the company as a whole is better positioned? When we look at the liability side of things, which is obviously what we're solving for here, we look at the debt itself and we say to ourselves, are there covenants here that need to be amended, reset based on a new business plan? Are we facing are we facing cyclical rather than structural issues here, which suggests that if we just push the maturities out, we'll be able to refinance the debt in the future. Is there anything we can do with the existing debt? So can we do a debt buyback or exchange? You know, or can we refinance using non-conventional means? You know, for instance, you know, we don't use the kind of bond markets, we instead go to a kind of private debt financer or something like that. And then on the equity side of things, you know, we ask ourselves, well, look, I mean, can we raise some equity? You know, is our share, if it's a private company, we say to ourselves, is the shareholder still supportive? Are they willing to put equity into the situation to solve it? If it's a public company, we ask ourselves, you know, do we have a large enough market cap to raise equity on the capital markets? And if none of those are possible, you know, is there the possibility of what's called a debt for equity swap, whereby we turn some or all of the debt into equity, which basically right sizes the balance sheet, puts the company on a stable footing, but obviously changes the ownership of the business. Okay, it makes the creditors the owners effectively. So that now the next thing I wanted to talk about is, you know, who are the stakeholders in a restructuring, and I think this is what makes restructuring, you know, like really interesting. This is kind of what I really relish about the job, because if you compare restructuring to, you know, what the rest of our business does, which is largely mergers and acquisitions, in mergers and acquisitions you're generally dealing with just two counterparties, a seller and a buyer of the business in question. In restructuring, there are a myriad of different counterparties. Okay. And if we start first, obviously, with the company itself, which has its management team. You know, they will be thinking about their jobs, their livelihoods, their reputations, their own personal liability as well, you know, in the event that they could be seen to have mismanaged the company. So there's that to think about. There's the company's shareholders, like I say, who will obviously, you know, that might be, you know, a private equity, a sophisticated private equity fund, you know, that is invested in this company, among others. It might be like the founding family, who will obviously have a very sort of deep connection to the business, a vested interest in keeping it alive, or it might be a public shareholder base, it might be pension funds, you know, individual investors and such like. But shareholders will obviously want to kind of maintain control and ownership to the extent they can, and so therefore they're a key stakeholder in a restructuring. Then you have what's called the creditors of the business, i.e. those institutions that have lent money to the company. And there's lots of different types of creditors. Okay, so you can have banks, Lloyds, NatWest, Barclays, etc. You can have bondholders, and those often subdivide into different institutions. So you have, you know, you have like pension funds in there. You can have what's called, yeah, sort of par kind of institutions, and then also you can have hedge funds, you know, your kind of aggressive vulture funds like Elliott or Partners or something like that, some of which you might have heard of in the news and stuff like that, which will, you know, use all sorts of shenanigans to try and extract value out of the situation, and often buy the debt in the secondary market at a discount. Okay, so the way they will operate will be very different to how a bank operates. But in addition to that, you have a full spectrum of other you know, non-financial creditors that are key to keeping the company running, right? So you have its suppliers, its customers, its employees. And when we're restructuring a company, we try and keep those types of stakeholder out of it, right? We want to reassure them that everything is ultimately going to be okay. All right, we're going to sort of restructuring out between the creditors and the shareholders, and, you know, the employees don't need to worry about it, the customers don't need to worry about it, the suppliers don't need to worry about it. Because if those types of institutions become concerned about the situation, then it can be very, very value destructive. You know, if your key employees start leaving the business, if customers turn elsewhere, and that's very, very important, for instance, with respect to government outsourcers, whose key, key customer is obviously local authorities and the government, right? If the government loses face in a business, as it did with Carillion or Interserve, etc., it will stop giving them work, and the business will shrivel and die. And also suppliers as well. I mean, suppliers often, you know, sell their goods to companies on credit terms, right? So they say, look, we'll sell you this and you don't need to pay us for 30 days. If they're worried about the company's creditworthiness, you know, because it's in a financial restructuring, you know, what they might say is, actually, you've got to pay me on demand. And that means a massive cash outflow for the company, which can just make a bad situation worse. And then the other thing is there's other stakeholders as well, right, that we need to be mindful of in a lot of situations, kind of regulated or regulatory stakeholders. So a classic example of that in the UK is pension funds. I mean, the pension can often be the biggest creditor in a lot of situations. True of a lot of situations in which you have a large number of employees. So that was definitely the case in Carillion, for instance. It was the case in Debenhams. It was the case, with BHS, British Home Stores. And there's actually, there's a lot of, kind of legislative, kind of governmental oversight in that regard. And then there's other stakeholders as well. So, for instance, like I say, I mean, I've restructured a lot of government outsourcers. Clearly, the government is a stakeholder, right? So they're really worried about those companies falling over because it will mean schools not getting built, hospitals not getting built, etc. And so, when you're restructuring a business, you have to think about all of these different stakeholders and how you try and align their real interests. How do you try and build, compromise in order to get a deal done? And a big part of that is like stakeholder management, negotiations, etc., a lot of gameplay, okay. But also, each of these different stakeholders will have their own sort of legal rights as well. And so everyone knowing and understanding their legal rights and protections is important to understanding what leverage they have in a restructuring in order to get the outcome they want, or in order to get as close to that outcome as they want. And look, we, Lazard, we will advise any of these stakeholders effectively. So, I've worked in situations where I've been advising the management team of a company, I've been advising the shareholders, or I've been advising one of these different kind of creditor groups. And another thing to say, just returning to that point around, the primacy of understanding your legal rights and protections, etc. We work hand in hand with restructuring lawyers. Again, in mergers and acquisitions, lawyers tend to come into the equation towards the end of the transaction. So once you've negotiated, a deal to sell a business, you ask lawyers to, draft what's called the sale and purchase agreement. Here, lawyers are absolutely key from the outset to understanding the respective rights and protections of each of the different stakeholders, how a restructuring can be implemented, including for a court process, for instance, and therefore, we work hand in hand with lawyers. So what's our role as a restructuring advisor? So look, you can break this down into kind of four parts, and this tends to come, I suppose, more or less kind of sequentially to some extent. But if we start with what we have in the top left-hand corner, so the first thing is financial analysis, right? So if if the company comes to you and says, look, we're running out of cash in 3 months' time, we have debt maturing in 6 months' time that we're not going to be able to refinance or repay, we need help. That often usually the first thing you need to do is get in there and assess the situation from a financial and commercial perspective, right? So you need to, you get the company's Excel model, etc. You go through their various sort of internal management reports, but you're trying to evaluate, what's the liquidity position of the company? How much cash does it have? How much undrawn sort of facilities does it have? What's its kind of its cash flow forecast? When exactly does it expect to run out of money? Is there anything that can be done to extend that runway? What exactly is does the capital structure look like? What debt instruments does it have? Who are the holders of that debt? What is the relative ranking of that debt? Because some of it will be some of it will be secured over assets, some of it won't be. And that creates all sorts of what we call intercreditor issues. What do the assets of the group look like? Are there any that could be sold, etc.? We look at the company's business plan, whether or not that's fit for purpose. Is it too optimistic? Is it too conservative? Are there other ways of doing things, etc.? We work out the value of the business. Okay, so we value the business because that's very important to working out whether or not, what we call, so whether or not the value of the business breaks in the debt. Okay, so if you have a company which is worth 100 million, but it has debt of 150 million, what that means is it has no equity value. The shareholders are what we call out of the money, and really, it's the debt holders that are the kind of the de facto economic owners of the business. So valuation, very, very important. as is debt capacity as well. So understanding, what is actually the sustainable debt load of a business. So financial analysis comes first. That's a lot of work in a compressed time frame. And then we move on to, more of the kind of what I would say self-help options. So before we start, running to the creditors for help, we think about how we can fix the situation or alleviate the situation to the extent we can. So, we'll think about, finance. So are there any refinancing options? Can we raise some equity? Can we raise some debt, even if it comes at a high price? Is there the possibility to do that in the future? Can we structure those types of transactions in such a way that we can get debt or equity in a creative way? The other thing is the more strategic advisory, M&A. So like I say, we'll look at the portfolio of assets that the company sits on, and we'll ask ourselves, well, this is non-core to the business. Could we sell it, or can we merge the company with another, or sell the company to another, etc. And it's for these reasons, incidentally, that we in the restructuring team work hand in hand with other teams at Lazard. So we work hand in hand with our equity capital markets team, with our debt capital markets team, and with the various sector teams that run, mergers and acquisitions. So, I've worked a lot with my oil and gas colleagues. I've worked a lot with, my business services colleagues who cover the sort of government outsources, etc. Once we've done all of that legwork, we might be able to fix the situation ourselves, fingers crossed. Otherwise, if it's clear that we're going to need something from the creditors, we come up with a proposal, right? And that proposal might include certain of these self-help elements. So we might say, look, the shareholder is willing to contribute, $20 million or whatever to the situation. We're prepared to sell this asset for which we think we'll get $50 million, etc. But we'll prepare a proposal and we'll take that to the creditors whose consent we'll need. And we say, look, this is the company's proposal. What we need from you is to extend your debt to, by 2 or 3 years. We need you to amend covenants based on our new business plan, or we need you to do a debt for equity swap, and here's the conversion price, etc. And then that is what starts the negotiations, okay? And the creditors will appoint their own advisors. We could be the creditors' advisors, like I said previously. And then we start negotiating a restructuring, which could take, it could take weeks, months, years. It really depends on, what is the reason for the restructuring in the first place. I always find that a restructuring happens for as long as you have. So if the company is running out of cash in 3 months, you're going to negotiate right up until the end of those 3 months. If the company, is going to run into issues in a year's time, you'll probably negotiate right up until then. And the reason for that is brickmanship, right? People keeping their cards held close to their chest, trying to extract the best deal they can, right? This is very, it's very much, it's a negotiation, okay, and that requires a lot of kind of commercial nous and savvy, but is definitely, like I say, the most exciting part of this job. How do we identify restructuring targets? So this again is actually a big part of our job. Obviously, we execute restructurings. That's what we get paid for. But people tend not to knock on the door for you for a restructuring, quite frankly. People, usually bury their head in the sand, or go to, people that they're close to. So a lot of part of the work we do is actually trying to work out which companies are likely to need some sort of restructuring, and actually proactively reach out to them and say, hey, look, do you need help with this situation? Have you thought about doing X, Y, and Z? And the way we identify, companies is, look, first and foremost, we look at how much debt is actually on the balance sheet. For us, like we're our fees are such that, we like companies that have large, complicated balance sheets that are difficult to unravel, and that's where we can really add value and justify our fee. So we tend to look at companies that have at least 200 million euros of debt. We wouldn't necessarily rule out anything with less, but usually, the company has to be of a sufficient size in order for it to be of interest to us, Lazard. It might be interest to other advisors, but that's usually like a kind of de minimis kind of cutoff for us. Early warning signs. So look, like I said previously, the key early warning signs as to whether a restructuring might be coming down the line are, the need for a company to ask its banks for some sort of covenant waiver, upcoming maturities, or another thing is, companies have, usually have like undrawn facilities that they can draw on as and when they need to, like an overdraft. Yeah. If those facilities are taken away from the company, that might be a sign of lessening support in the company from its lenders, but also it means the company has less liquidity, right? Has less cash to access if it needs to, and that again could be an early warning sign. Another good one is market prices. So both debt and shares, that are listed will have a price, and if those prices are coming down, needless to say, that can be a cause for concern. At the moment, all prices are coming down. The reason for that is because that's more of a macro issue, right? That's more because yields are increasing in the US and by other central banks, so that pushes other prices down. But nonetheless, it's a very good indicator of distress. Obviously, financial performance, right? So if a company's is loss making, if it has significant contingent liabilities, if performance is deteriorating, etc., that can be a strong indicator of potential restructuring. And then also there is regulatory changes which we discussed previously. That can have a massive impact on a company. And then lots of companies, their debt is rated by credit agencies. And so if a rating agency downgrades that company's debt, again, that can be a sign of distress. And also, lastly, management. So if there's a turnover in management, if they're constantly changing their CEO or CFO or whatever, that can be a good indicator that a company is heading for trouble. But by and large, we do a lot of this identification on a desktop basis and research. But really, the principal way of working out whether or not a company is really in trouble is through market intelligence. So there's a whole ecosystem, as it were, of restructuring professionals, be them lawyers, financial advisors, investors, etc., that we speak to on a day-to-day basis. We all know one another, we all work with one another or opposite one another, and we're always sort of comparing lists of names and discussing who knows what, etc., and which companies are worth pursuing.
Ed, I just wanted to give you a time check because it's 10:10. I've already seen that our students have got loads of questions in the chat. And sure. So I don't know how mthis you've got left, but I was going to leave at least 15 minutes for questions. So this to be honest is going to be pretty much the closing side, which is to say, now more than ever, I think, well, not more than ever, but now we find ourselves in a particularly interesting time for restructuring, right? Because there is so much, everyone's worried about the economic outlook, right? With rising inflation, with rising interest rates, that's going to have an impact on the macroeconomic picture at large, and that is likely to kind of lead to a lot of restructuring opportunities for us. And I've just included here some sort of headlines that bring that into perspective. So look, that's all I kind of wanted to say on that front. And apologies if I slightly overrun, but hopefully we've got a good amount of time for Q&A. Marissa, will you sort of manage this? I can see some people, but not all. Yes, no, I will do for you. Do you want to stop sharing your screen and then I can see everybody a bit more? More well, but I noticed in the chat there was a couple of questions. I don't know if you can see the chat. Let me just pop it up, which we can. Oh, I've got to make it big. So there was there's a few questions in there. So someone asked, would you be willing to share your slides after the thing? Up to you. If you're happy with that, then if you just drop me a copy, a PDF version, I will make sure that's shared with everybody and saved somewhere. So somebody said, can I ask which source your global announced transaction, where you get your global announced transaction data from? Bloomberg? ?
Refinitiv.
Okay, Refinitiv, very good. Thank you, easy one. How do you manage the discussion with lenders of companies going under a restructuring process? And do the lenders always follow your suggestions?
So look, firstly, so this depends, right, on whether you're advising the company or the creditors. So let's assume we're advising the company. You know, basically, yeah, a company will owe its duties to, you know, all of its financial stakeholders. So it's shareholders and also its creditors, and whether it owes its duties primarily to the creditors rather than the shareholders depends on whether, you know, the shareholders are still in the money. But, you know, what you often find in a restructuring situation is, you know, your first proposal is what we call shareholder friendly, right? So you're trying to keep your shareholders in the game, as it were. So, you know, you would generally propose something which is more favorable to the shareholders than it is to the creditors, in the anticipation that they will probably push back on that. Okay, so for instance, let's say, you know, a company, I'm advising a company that needs more money, and also needs to extend its maturities. So I might say to the company, look, the shareholder's willing to put in 20 million euros, but we need a 3-year extension. And the creditors come back and say, no, we want 50 million euros from the shareholder, and we're only willing to do a 2-year extension. That's I mean, a very simplistic example of the to and fro that we might have between companies and lenders. But if I'm advising the company, and the company delivers a proposal to the lenders, I mean, you can guarantee that they will come back on it. They won't be like, yeah, that's fine, great, let's do that. There's always going to be a negotiation in that regard. If, on the other hand, you know, I'm advising the creditors, then they probably will follow my advice more, because that's what they're paying for. But nonetheless, they might not do so, right? And what we're generally trying to do, and when you're advising creditors, you don't usually advise just one creditor, you advise, you know, many. And you have to build consensus among them as to the kind of, you know, proposal or counter proposal or the solution that you want.
Great, thank you very much. I'm going to go to Natasha, Ireland, and don't forget, Natasha, to introduce yourself, where you're studying, what you're doing, and while she's doing that, my colleague Daniela is going to pop in the chat the evaluation link for Edward, so we can send him your thanks for the session and your feedback on what you've learned from him. So please click on that and fill that in. But Natasha, the floor is yours.
Hi, so my name is Natasha. I'm a second-year maths and physics student at the University of Manchester. My question was, like, obviously you moved from PwC to Lazard. I was wondering, like, what made you decide to move, and have you found, like, a huge difference in terms of, like, especially like culture between, like, PwC and Lazard? Thank you.
Yeah, so I guess a number of factors. I mean, I guess the main one is, you know, PwC was a great training ground, and like I say, you know, it provided the full suite of restructuring services, but the market has shifted ever since the financial crisis, effectively. So the part of restructuring that interests me most is the balance sheet restructuring, is the financial advisory, you know, not the operational restructuring, not the pensions advisory, etc. And more of that work has, over the last 10 years, you know, migrated from big four accountancy firms who historically had good relationships with high street banks in the UK. It's migrated from them to, you know, the US orientated investment banks that have good relationships with, you know, the sort of the kind of, you know, what we call the CLOs, the credit, the kind of, you know, the collateralized loan obligations, and with the kind of hedge funds, etc., that you see more and more in restructurings. So I mean, for me, you know, who wanted to just focus on, you know, financial advisory, I was like, okay, I need to really work for an investment bank. That's one reason. Also, they pay more. That's another reason, not gonna lie. In terms of culture, now the culture is different, but for me in a better way, right? So PwC, I had a good time at PwC, but it is a bureaucratic behemoth, right? It's a very large organization in which you can feel very small, quite frankly. And so, you know, I really enjoy working in a team of 17, you know, of very, you know, keen, clever, you know, bankers. We can operate nimbly, you know, we're internally networked very well, right? So we can leverage our other kind of colleagues well, whilst in PwC you might not even know who the right person to speak to is if you need someone to help with a certain sector, etc. So culturally, in that regard, I much more prefer the smaller size. I mean, when I moved from an accountancy firm to an investment bank, yeah, I'm not going to lie, I had reservations about whether the culture would be much more cutthroat, like Wolf of Wall Street or something like that. But actually, I was very, very pleasantly surprised. It's very collegiate and collaborative. It's not remotely sort of combative. I think firms like Lazard have done a lot to change their culture over the years because they have to, right? I think people's expectations with respect to work have changed and continue to change. And if firms like this don't treat their employees well, they're not gonna be able to recruit the best talent. So culturally, it's been good.
Great, thanks, Ed. I just wanted to someone has written up on the chat from Eleanor. She said, "Thank you for an insightful session. I had no idea this aspect of finance existed." So thank you for sharing, what it is that you do. Mark Ferreira, I think that's how I say your surname. You had your hand up quite early.
That's correct. Yeah, thank you. Hi Ed, I'm Mark. I go to the University of Warwick and I'm an incoming second year economics student. I just wanted to ask, when you mentioned that you do the financial analysis before you actually get into the restructuring, you value the company. So is that done in-house or do you outsource that work? And what kind of techniques do you use for that? So do you use comps or or is it dependent on the company? Thank you.
Yeah, so we would generally, it's in-house for sure, but we would generally leverage our sector colleagues for that. And so what I mean by that, right? So Lazard, you have product teams and you have sector teams, okay? So the product teams are restructuring, equity capital markets, debt capital markets. Then your sector teams, which are doing M&A, they just split by different sector. So if I'm working, when we worked for the creditors of Premier Oil, okay, we worked hand in hand with our oil and gas company. We needed a valuation in order to understand, what the art of the possible was with that transaction. So we got our oil and gas colleagues to pull together that valuation, because that's the sort of thing that they would do day to day, when buying or selling a company, right? That's their bread and butter. In terms of valuation methodologies, I mean, it's generally the standard ones, right? So trading comps, transaction comps, DCF, NAV. I mean, it will vary from sector to sector again. So like if I'm valuing, I mean, oil and gas companies are generally valued primarily on a DCF basis, whilst, retailers will be valued on a multiples basis. But I mean, just standard sort of valuation methodologies in that respect.
Great,
thank you.
Thank you. Shall we go to Diksha? Raj?
Hi, thank you so much for your talk, Edward. It was really insightful and interesting. So someone mentioned your move from PwC to Lazard, and I just wanted to ask, was there like a technical gap that came with that in terms of the knowledge, and how did you go about like closing that gap, and what was the one thing that you wish you had known before you came in about this particular sector? Also, sorry, I forgot to introduce myself. I'm at the University of Warwick studying EPP. Thank you. Thanks.
So to be honest with you, I didn't feel like there was much of a technical gap. I mean, bear in mind that I was working in a restructuring team in PwC. So the move, I felt like I was doing more or less the same job, but perhaps with a different sort of emphasis. I guess the thing that I had to learn is how do I reinvent myself from being basically an accountant to an investment banker. And so when I worked at PwC, it was more, I suppose, analytical and granular. So we might write sort of independent business reviews, for instance, like kind of diligence a business plan in a fairly kind of methodical fashion without really spelling out the key issues and takeaways which will guide a restructuring transaction. Whilst, you know, at Lazard, it's very much, you know, we're dealing with, you know, our clients are people that are, you know, very busy. You know, they have sometimes a short attention span. They want to know the key issues, the key takeaways, and also they want to get a deal done quickly, right? They don't want to wait. They don't have to wait 6 weeks for some big report or something. They just want to know what they need to know and move on with the negotiations. And so I think just a change of style in terms of the deal making, and the consequent workload is what I experience, but no real technical mismatch, if I'm honest.
Thank you.
Great, thanks very much. How about we hear from Sasha Hymanson? Sasha, I met you on the desk yesterday.
Hi, I'm Sasha. I'm a second year economics student at Durham. And I was just wondering a bit about how Lazard actually makes money from these restructuring advisory deals. So obviously you're dealing with distressed companies. So what is it from fees, I assume? And like, how do you decide the size of the fees? And is there any companies which you might think are too far gone to help? Thanks.
Yeah, good question. The most important question, in fact. So look, the way it works is we usually have a fixed fee, what we call a success fee, which is payable on the consummation of a restructuring. And it's generally as simple as that, actually. Now, needless to say, you can find yourself in a situation where there is no successful restructuring because the company's gone bust beforehand. So Carillion is an example of that. Thomas Cook is another example of that, right? Those are 2 deals where we didn't get paid our success fee because we weren't successful. How do you sort of compensate for that? What we generally have are what's called retainers. So we will charge a monthly fee of, you know, $50 to $250, you know, $1,000, which is then offset potentially against the transaction fee, you know, if against the success fee, if indeed we are successful. So that gives you some downside protection if things don't work out well. And then how do we price that? It's usually based on, you know, anticipated intensity of the project. So if and company engagements tend to be more intensive than creditor engagements because, you know, creditor engagements are just that a little bit more reactive. But that's, you know, that's kind of, and also like you're trying to second guess, you know, what our competitors will price the project at as well. But that's generally the kind of rule of thumb. And yeah, look, I mean, you know, there can be some situations which, well, look, I mean, if a company is too far gone, as you say, they would probably hire someone with insolvency like capabilities. So, you know, they might hire a firm like PwC that has insolvency practitioners that can take on the administration or the liquidation if it comes to that. We don't have that capability. So, you know, if a company is close to that, we probably wouldn't get involved.
Great, thanks. Thanks,
you.
Ed. I think we've got time probably for one more question. Polina, I can see you there. If you want to introduce yourself.
Thank you very much. My name is Polina. I am a current student in real estate master program at the LSE, and I wanted to clarify. You mentioned that banks can't do restructuring sometimes. Can you please repeat this?
Okay, so let's
explain.
So let's say like Goldman Sachs, they might have like, let's say they raised some debt for a company, you know, so they syndicated a loan, they own some of that loan. You know, is it really appropriate for a company, for Goldman Sachs to advise the company when they are a creditor of the company? Doesn't that create an inherent conflict of interest? And so, you know, and that might not be the same in every situation, but it's become it's the case in so many situations that people just think, oh, I don't know, let's just not bother inviting Goldman Sachs or JP Morgan to pitch for this restructuring mandate because it's going to be a real pain getting them to clear conflicts. Let's just invite, you know, PJT, Rothschild, Lazard, who we know won't have those conflicts of interest because they don't have a balance sheet. Yeah, so I think over time that's just meant that those types of institutions they're just not really on the scene in this respect.
Thank you, Edward. Now I understand. Thank you.
Yeah.
Great. Okay, look, got 2 minutes. We'll make the most of it. So who's there? Is it Hugh? Oh, no, I don't want to like guess your surname because I will say it incorrectly. Nguyen?
Yeah, it's Hugh Nguyen.
There we go, close as I'm gonna get. Ask away, you've got 2 minutes.
Yeah, no, it's hi Ted, hi Ed. Thanks for your time. Quick word about me. So I'm an incoming master student in finance at the University of St. Gallen, in Switzerland, and I'm currently doing a summer internship in growth equity. So I guess my question is, how does the workload looks like in restructuring? Because it seems like, I mean, every day your client is burning cash, and the more the process is going longer, the more chance the restructuring will fail. So
yeah.
How do you?
Yeah, sure. Yeah, so look, I think yeah, in terms of tangible workload, I think it depends on what stage you're at in the project, and what level you are at in terms of yourself. So like clearly, as I said previously, at the start of a project, you're doing like a much more financial analysis and fact finding. The way in which your participation in that will depend on where you are, in the hierarchy. So an analyst is going to be doing a lot of like, granular financial modeling. An associate is going to be checking a lot of that, maybe, like reviewing debt documentation and such like, as well, to kind of assist and supplement that. And then, they'll both be working on pulling together, PowerPoint slide packs, etc. Then the more senior people on the team, so the VP, the VP, the D, the MD, they're probably going to be having conversations internally and potentially externally with colleagues to work out what the various strategic options are. So can we sell that asset? Can we raise debt there? Can we raise equity there? They might be having conversations with lawyers as well to think, well, here is the group structure. Perhaps we can be creative by raising debt against that entity, etc., etc. So it really depends on what level you're at, and then that kind of that sort of differential can kind of expand its way through into other like stages of the project. I'll have to pause there because I'm conscious that we're at time.
No, brilliant. Well, look, Ed, I can't thank you enough for that was a really great insight into what you do for a living. And like you say, some of these guys have never heard of it. Even Daniela, who is on our team, said, Marissa, what is restructuring? So hopefully, Daniela, you now know. But thank you for giving up your time. Thank you, students, for joining us, for signing up and showing up. So important. The link to give Ed feedback is up, so please click on that, and so we can share with Ed some of your thoughts about what you've learned today. And we will see you. We've got handling technical interviews coming up next at 11 o'clock. So hopefully we'll see some of you there. And I know someone asked the question yesterday about brain teasers in interviews. So I think that's one of the things that will be covered. So, so Ed, again, many thanks. Enjoy the rest of your day.
My pleasure.
Have a great weekend.
My pleasure.
And, we'll be in touch.
Thanks all for listening in, and good luck with your careers. Yeah, take care.
Perfect. Thank you. See you all later.